I have a few of my colleagues with me, Group CFO, Vice President, Corporate Banking, and also other business leaders, also people from finance to answer whatever questions you may have. So this is part and parcel of an exercise that we are going on investor relationship and then to advise whatever the questions you may have. So please feel free to address those questions through the team provider. What I'll do is I'll take you through the presentation, which I believe that we shared with you all earlier. Maybe about 10-15 minutes, I'll go to the slide, explain some of the key points, and thereafter we'll take on the question about the group structure, and where we have four subsidiaries, and also the investment banking on the page, which are all 99% subsidiaries of the NDB Bank. And the next slide is about how we have evolved over the years. So 1979, bank initially started as a development bank, and then through acquisitions and the merger with the NDB Bank, NDB Development Bank that happened in 2005, and prior to that, the Indian Amco acquisition was 2001. So with that, we are moved into commercial banking, corporate banking, and in this today, we are focusing on retail banking and SME space. So right now, we are operating with 105 branches. As of the year end last year, 104 branches. And you see of the branch network, about 50 of those branches have been added on to the network the last 5 years. So that's where the significant growth that we have made in terms of branch expansion has happened in the last 5 years. So that's actually, I would consider it as a hidden reserve that we can capitalize on the investments that we have already made. So moving on to the macroeconomy and the industry overview, that the global economy, the world economy grew by 3.1% in 2016. China, we saw kind of soft landing, and the largest trading nation, China being the largest trading nation, posting a lower GDP in 26 years. So that was one key point there. And also the global demand that continues throughout 2000. We're talking about the Sri Lankan economy. That's where the GDP growth was also lower than what we expected, around 5% in 2015. And a couple of the policy reforms also were taken, enhanced current flexibility, which contributed to the short-term stability of the economy. And the annual average inflation was around 4%. The regulator also did some key policy decisions in terms of changing the statutory reserve requirement in January, which was increased up to 7.5%. And also, if you access from January 2016 to December 2016, for the year, the interest rate also up to around 230 basis points. So that was a significant increase, and these are all signals given by the regulator in terms of curbing the rate, which was very high in 2000. So to manage the policy side, the decision taken. So as a result, overall credit growth was limited to around 17.5% in 2016. This is the entire banking industry, compared to 21.2% in 2016. Deposits at about 16.5 growth. I'm talking about the industry again. Last the previous year, 15.3. The margins, the interest margins that are one of the key contributors, that has remained. The industry margin has remained at 3.6%. despite the increased cost of funds, like industry saw cost of funds going up, 230 basis point policy increase, and as a result, but the industry NIM, so it came down, it is around 3.6%. But overall banking industry, I think profitability has improved, mainly due to low credit losses. The entire industry NPL ratio improved about 2.7%. So that's a key contribution for the banking industry profitability last year. Next slide, give some details about some of the awards that we have received. One of the key awards was the CFA Sri Lanka. We are selected NDB as the best for the best investor relationship, and we got the gold award. This year we got the silver award. So that is one of the key milestones, and I think the interactive seminars like this, the webinars, would help us to, that we are quite here to share our views and then answer investor questions that we may have. And that was the reason for arranging this. Yesterday evening, we released the results to CFC, and soon after, the following day, we have called for this webinar to share their stand. Euromoney also, bank got actually the NDB Investment Bank got for a 5th consecutive year as the best investment bank in Sri Lanka. And also, for the first time, NDB Capital of subsidiary in Bangladesh also was awarded as the best investment bank in Bangladesh. Talking about investment banking activities, that is one of the key milestones was last year also we get the industry leadership in terms of becoming the leader in raising the check for the industry. So last year the investment bank was involved in raising with 31.5 billion worth of venture, and that's roughly around 40% of the market share. So that we have continued that leadership in that field. Moving on to financial performance of the bank. In terms of profitability, the operating income, we had 8% growth from the 12.2 billion rupees to 13.1 billion. And on the other side, the operating expenses had 7% growth. So, like positive jaws in terms of the cost income. The profit after tax, however, there's a 10% reduction from 3.5 billion to 3.1 billion. This is mainly because of high impairment charges. When it comes to the next slide, I will explain more about it. In terms of the balance sheet position, the total assets had 8% growth from 390 billion to 335. We roughly account for about 4.5% of the market share in terms of the assets. And total loans had 9% growth, 215 million to 234. And we need to assess based on the direction that the regulator also gave last year to curtail the credit growth. And we were focusing on improving our margins, retaining our interest margin, and focusing on quality asset growth rather than going in terms of volume. So that was one of the strategies that was taken last year. And in terms of deposit, that's 10% growth from 185 billion to 204. So roughly about 19 billion in terms of deposit. That was. So the growth in deposit, you would note the rate of growth in deposit compared to growth in loans was high. 19 billion deposits compared to 14 billion in terms of 15 billion worth of loans. So the rate is so So consciously we were building up our deposit portfolio because historically our AD ratio was high. So that was one of the contributions to bring down the AD ratio. We being a development banking institution, as we mentioned earlier, converting commercial and retail space. They're quite young in terms of retail growth, in terms of number of branches. So that is the reason that the AD ratio higher than the industry average, but that's the consciously building up to bring it down. In terms of efficiency, cost income ratio has improved from 49.5% to 49%. So this is an area where relatively we are better, but still, I think, compared to larger financial institutions here, it's a scale game. So I think that we have further room to improve in terms of cost income. Net interest margin, despite the rates going up, we have managed to sustain the margin at 2.6%. So that's one. I would say one side is satisfactory in terms of sustaining that margin. But on the other hand, compared to industry, we are below average. So that's the area that we are working on. And in terms of return on assets, return on equity, that has come down from 15.6% to 13.4%. That's again an area that we have to focus on going forward, mainly because of the drop in profitability compared to last year. The income statement gives more details about the net interest income and the other income contribution. So overall, the operating income had 7.7% increase, 942 million in terms of the variance. But as I mentioned, the major area where we suffered was the impairment charges, which went up from 712 billion to 1.3 billion. So almost 655, almost double of what we have provided previous year. So that's one of the concerns. But of course, that is on prudence on our estimation in terms of the specific customers. But we are comfortable of in terms of recovery. In some cases, we have security. So that prudence-based provision. And in terms of operating profit, it has come down from 5.4 to 5.3. And tax increase is partly due to VAT increases and also the tax rate. So the below, some of the pictorial assessment, you would see that contributions have increased. NII, the improvement is 965, but that has been because of the impairment charges, and also operating expenses, about 399, which is about 6%. I think that's reasonable compared to the 6% increase in operating expenses compared to inflation and also the salary and all that have taken, and also on top of that, element that came in for all the administrative costs that we were incurring, especially in the second half, security service and all that and on with the additional components, so that's 4%. So given that context, the increase in operating expenses, I would say reasonable, but as I mentioned, in terms of our cost-income ratio, there's more into cost improvement. The other slides are about how importantly how the net interest income has grown and detailed breakup of the quarterly improvement. I don't want to spend much time on that, but I'd like to draw attention to the other income side. That's an area that we are quite keen to focus even going forward. The fee and commission income has 11% increase from 2 billion to 2.25 billion. So that would be one of the key areas of focus going forward. We have quite a good corporate banking and portfolio and good cash management business. So this is an area where we should be able to capitalize on going and other one is on the forex side. There is a lower contribution of that 1 billion minority. This is mainly because of the less lower ALM activity and also the forex operation. And in terms of the opportunity by the ALM, there were less options last year. Moving on to operating expenses. Overall, the operating expenses increased 6.6. Of that, personal expenses 7.2% compared to inflation and increases and all. That is reasonable. Depreciation is a small component, but other expenses 4.2%, partly due to the VAT that I spoke of earlier. So overall cost to income ratio has improved from 49.5 to 49%. Cost to average asset ratio has improved again from 2.1 to 2. And one significant point that I want to highlight is the branch expansion. Last year we added 11 branches to our network, so 93 branches, 104 branches last year. And also we have made some additional capital expenditure in terms of technological enhancement that has actually resulted in higher depreciation. And major portion of the personal expenses increase is also due to the branch expansion. 11 branches and even average 7 people per branches and about 77 additional staff. So that's another reason for the personal expenses. So when managing the cost income ratio below 50, given those we being relatively young in terms of branch expansion and 11 branches, it added to the system, and with that additional staff, I think that is commendable in terms of managing cost income below 50%. Moving on to the balance sheet. The assets had a modest growth of 8%, total asset 8%. Loan growth, as mentioned, was curtailed. One was the interest rate, and one was the inflationary policy measures that we explained. Whereas deposit growth was higher than the loan growth, but there again, most of these deposits came from fixed deposits. So as a result, our CASA ratio still remained around 20%. So that's an area, I mean, that's a factor that we noted in several banks. Deposits are coming with an interest rate increasing scenario. Naturally, the tendency was to move away from CASA to high interest rate. Another issue is that the interest rate differential with fees and the sales deposits was quite high. So in that scenario, actually, there was a tendency for the entire bank industry customers towards deposits. So the balance sheet size was 335 billion. Moving on to the asset quality. The loans and advances. We had 9% year-on-year growth in 2016 from 99 billion to 180 billion. And you see the growth where it has come from. The retail and SME sector that has contributed 41%. corporate 33%, and project finance 23%. Project financing is a key area where bank was involved with several infrastructure projects. Whatever you want to add on side for corporate and project.
Now, the corporate banking was conscious to diversify the portfolio and illustrating the portfolio contractor because that was on a conscious decision. But on the other hand, project finance on a selective basis, we have got involved in some large construction projects, which we currently have read as some other energy-related projects which have taken forward the growth into the financing.
So if you see up to 2016, we were growing at a rate of around 26% CAGR. But last year, the growth was curtailed. One was the interest rate, the high interest rate scenario, and also the input that came from the regulated in terms of curtailed. In terms of the other contribution on the retail and SME space was significant. That improved from 39 to 41. Which reflects the investments made in master as well as actually increasing that. And going forward also that will be one of our focus areas. Talk about asset quality. The portfolio mix, you see agriculture exposure is 10%. This is again a repeatedly mandated area. And, we are meeting that requirement. In the hotel sector, again 10%, metal, chemical, and engineering services, 10%. So it's you would note that it's quite a well-spread portfolio, not concentrated in one particular area. The 21% is on the services side. So that's various customers, so many companies there. In terms of NPA ratio, we have given a breakup of sector-wise ratio. And one significant area is on textile and garment. That's due to that was not willing to get the price in the service. And that was specific customers, so on the industry. But some provisions that we had for 2016 was systemic or general provisions we had in terms of plantation, and because this was one of the historical NPLs, whereas the exposure in the textile and garment denominator has come down. So that's the main reason for I chose the high you know, also the conscious to brought down the textile and garment portfolio down to get the ratio. In terms of gross NPL ratio, we are maintaining the rate above the industry average. So we have been trying to work around 2.5 kind of ratio. Whereas the industry also improved over the years, especially during last year, coming gradually to the same level as we were making. Moving on to the slide on the deposit side. Again, 10% growth in deposit. There again, the pie chart shows CASA current and savings now. It's about 23% compared to the other deposits of 77. Within that 23%, demand deposit 8% and savings 16%. So this is an area where we will essentially focus going forward. And as I explained earlier, being relatively new in terms of branch expansion, our ratio is probably below the industry average, especially shaken in the larger banks. But this is an area where we see a lot of opportunity to improve. In terms of liquidity, we maintain 21.9%. banking, exceeded 0.9%. On the capital side, capital adequacy ratios, both Tier 1 and Tier 2, we remain very much above the regulatory requirement, minimum requirement, and right ahead of that. Tier 1 capital ratio is at 9.3%, and Tier 2, 13%. Total capital ratio of 13%. So we are quite comfortable there. But as we go along, as we go on with our own story, and especially with Basel III requirements coming, so there will be more capital there required to support this growth and also capital ratios. So that is something that we can work on going forward in this year in terms of supporting capital growth. But at the moment, we are quite ahead of the capital requirement and also our own internal buffer that we have kept. We have those buffers. That's something about the investor ratio as maturity audience would be interested at. Earnings per share, it has come down from 21.2 rupees to 19.19, mainly due to a 10% reduction in the profitability. ROE, again, 15.6 to 13.3. And while book value per share has gone up from 137 to 149. So right now the share price is trading around the book value of our share. Right. 150 to almost at the book value. Price earning time 3.1 and price to book value 1 time. Share price movement details are given. It has been a reflection of in the market as we have seen last year. You need to defend, so some reduction in share price. So when let's move on to the question and answer session. So we would like to welcome the questions, and we can type in and send those questions. We are happy to provide clarity with regard to these questions. So far, we have not received the questions, but you can see.
Yeah, ladies and gentlemen, you all could go to the chat mode and just type whatever questions you all have, and we see those questions and we can respond to the best of our abilities. As you all see, we also have a new CEO. So if there are any questions with regard to the future of the bank, the strategy, please, you are most welcome to ask.
There is a question asking for reasons for our impairment during the quarter or during the last year. The last quarter was where we looked at translation sector very critically, and on that, looking at the overall situation in the country, where the prices and also key export volumes have come down, and taking that into account, and also with the wages going up in terms of productivity. With all that taking into consideration and looking at the characters of those companies, we took that to
your ambition to reach that?
Okay, there's another question on our expectations on loan growth and deposit growth for next year. Okay, I think, and also the target loan growth for 2017-2018. At the moment, we are working on a strategic plan, and in that strategic plan, we will be looking at 3 to 4 year horizon and see what are the ways to improve our growth. So, since the strategy is being formulated, I don't think I can comment about what numbers that we are looking at. But certainly, it could be about market growth rate that we are looking at. We are the market, 1.5% market share. So we have to have growth rate about market growth rate. So that's the only thing I can share with you. So as we finalize once we finalize our strat plan, maybe later next quarter, we have another review analysis after our first quarter results. Share more details about it. Okay, how many branches do you hope to open in 2017? Yeah, again, that would be part of the strategic plan. As we looked at that about 11 branches were added on last year. Previously, again, about 110 branches in 2016. But for the time being, about 3 to 4 branches where we have already received the bank approval. We are working on with various landlords in these branches. But there have been a lot of relocations, a lot of branch upgrades that have been planned. For example, we relocated our Vinapur branch. Cheaper location with a lot of ample parking space. So we are trying to improve not only the branch network, but also the facilities that are provided to the customers. And also there are other channels to improve our reach. The digital channel would be one of the areas where we can work on more to reach our customer base. There's a question on how do you foresee interest rate issues and also what do you expect the interest rate to be in 2017? Do you see room for further increase? I wish I had a crystal ball to give some good prediction, but unfortunately all of us are we have to very part of a guessing game, part of assessment. So based on the investments, the foreign borrowings that are being lined up, the indications are that rates, the currency should stabilize and the rate should get stabilized. But on the other hand, the signals that we are seeing, inflation has gone up. And the credit growth still remains higher than what the regulator is expecting. That can be a whole situation. So it's a balance, and this is where you have to work in. So in that situation, it's quite difficult to predict or estimate. But for the bank, in terms of interest margin, we will continue to work on the margin side, because that's where we feel there's enough room for us to go around compared to the industry average. So we will focus on what we can do well in our control, with the improvement on interest margin. So we will continue to focus on improving our margin side to address this issue. Okay, there's a question on is the increasing interest rate and subsequent impact on interest income. How do you plan to maintain cost-to-income ratio? Cost-to-income ratio is 49%, below 50. But there again, there's still room for us to improve. One reason the cost-to-income ratio 49%, but this is despite growing several number of branches. So one side, we have managed below 50%, but there's room to go. Another area is focusing on the fee-based income. There we see more opportunities to improve on, looking at the fee structure and looking at various convenience factors that we can offer to customers where we can get fee-based income. So there's enough room to go on that. And that's where we are on a this facility and those power to ensure those facilities that the fee-based income will be part of the regulation assessment that we move forward. So one way to address the high scenario on the fee-based income. Other one is on growing the CASA base. There again, there's enough room. 23% is the CASA ratio, but the industry average around 40 or 35-40. So we want to be there in years' time. So this is the investment that we are doing already in terms of branch network. 105 branches now. So they are being established there. More than 22 branches in less than 2 years. So when those branches established themselves, that's where we get more deposits coming, low cost deposits coming. There's a question about what industry sector are expecting the growth to come from.
Looking at the development that is taking place in the country, one obvious area would be the construction and the steel and the hardware industry. That is in line with the development that is taking place and also on the Indian level.
The other area that we will be focusing on would be on the side, apart from the corporate side. There are the branch expansion, there's a lot more opportunity. We are at the right places, and with the handy infrastructure, the road network, and our developing, and with the road not only limited to Western province, but some scope in other provinces as well. Capitalize on and support the growth part of the economic growth activity in the country. So that is one of the aims for the National Development Bank, going as a national bank in this sector. So that would be a focus area. What do you We have a question about the exam and answer that. The question: currently term loans are given at fixed rates of floating rates. There will be a further rate hike in the future. How do you plan to maintain NIM? Actually, we have both options: term loan and term loans in either fixed terms as well as floating rates. Both options are there. It's up to the customer to select what option to take. Of a loan book, 80% of the loan book is on a variable term. So even if there's a interest rate hike, the impact is not that significant. So 20% on term. On the other hand, rate improves, probably in the second half, there will be a positive flow of funds there. So that's the 80-20 in terms of its story. course, there's another question about targeted EDR ratio for 2017 and 18. So this is an area where we are currently about around 15%. We would naturally bring it down, and ideally it should be below 100. But it's a long way for us to achieve 1 or 2 years. Maybe 3 years time, we would like to see it below 100. So we are health assumption in terms of liability. It could be more liability given those coming years. Seems that there are a couple of questions now. Okay, how much is your market share in credit card segment? I think we don't have the entire credit card segment information as of December, but in terms of the exposure, ours is around less than 2% kind of market share. But this is again an area where we can focus on. There's more room to go. There is still room for a couple of players to get down. And it's all the value proposition that we bring in terms of credit cards, how you acquire them, and what services that we offer. So there's a lot more that we can do, which we are working on. There's a question on given the weak macroeconomic outlook at the moment, we expect asset quality to worsen in 2017. I think Sri Lanka has gone through the worst during the height of the war. And from where it was, the insurance ability, the insurance industry has come down to 2.7%. So, if the underwriting standards are maintained at high level, and if you don't follow up the recovery and also connection, maintain the capacities properly planned, I don't think as the industry whether should get weaker anymore. Of course, if the interest rate goes up, depending on inflation and the capacity, there can be segments which may have an impact in their capacity. But if we talk about a bank, the underwriting standards have been historically very good. How do you manage the relationship? How you are proactive to what's happening in the industry and take proactive measures. So that's where the capacity will be in terms of selection, in terms of funding, calling and selecting, and also the recovery side. If those are segments and underwriting standards, historically India has quite a significant good flow of good credit knowledge from the banks. So we have been a development oriented institution as a result. We have just some good quality credit. So underwriting standards are good. To maintain those standards and to continue to improve on the collection side, that is where I think we can maintain a good ratio of our standards are better than the initial. That question on how much should be the capex per branch in line with effective management system. Capex per branch, I think differs from bank and also the model. So it's not proper for us to discuss about that openly. But from bank to bank, it differs. Some banks go with minimum number of 4 or 5 staff, whereas some banks with a higher number of staff. And also what services that we offer. And some banks we offer full service, including another service. Some offering limited service. So it's depending on what services we offer. So varies from bank to bank. And also it's branch to branch as well that varies.
Also, what is more important to us is not the amount of capex. The break even as fast as possible. And we have seen that some branches even like breaking even 18 months and some branches taking more time. So it is not the quantum of money we really invest, but that is the focus. But the focus more is to quickly break even.
Okay, I think those are the questions that we are using. Those are the questions. So thank you very much for your attention and also raising questions. And we will be releasing transcript of this discussion and the forum, the video of this session within few working days. And we are looking forward to similar kind of interaction going forward as we move our relationship. And thank you very much for the attention given. Thank you very much for also for